On January 1st, 2026, India assumed the rotating chairship of BRICS, the economic bloc representing Brazil, Russia, India, China, and South Africa, along with newer members including the United Arab Emirates, Egypt, Ethiopia, and Iran. The announcement from New Delhi was technical, almost bureaucratic, buried in economic policy statements that most analysts skimmed past. India's priority agenda item: operationalizing cross-border payment infrastructure through distributed ledger technology. Translation: make Project mBridge fully functional. If you haven't heard of mBridge, that's intentional, because what it represents is not a product launch or a tech innovation in the consumer sense. It's the construction of a parallel financial architecture designed to operate outside the reach of Western sanctions, outside the surveillance of correspondent banking, and outside the dollar system that has anchored global trade since 1944. This is not a story about cryptocurrency or blockchain hype. This is a story about central banks, about the actual institutions that create money and settle international trade, building a system that makes the United States' most powerful economic weapon significantly less effective. For 50 years, the US dollar wasn't just currency, it was leverage, control, and enforcement. That control just encountered its most serious technical challenge. To understand why mBridge matters, you need to understand how international money actually moves today, because the system most people imagine doesn't exist. When a company in Thailand wants to pay a supplier in China, the money doesn't travel directly from Bangkok to Beijing. It routes through correspondent banks, almost always in New York or London, because those are the financial hubs where dollar liquidity exists and where SWIFT messaging connects the global banking system. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is not a payment system. It's a messaging system. When Bank of Thailand sends payment instructions to Bank of China, SWIFT transmits the message, but the actual settlement, the movement of funds, happens through correspondent banks that hold accounts in US dollars. This architecture was built in the 1970s when international trade exploded, and banks needed a standardized way to communicate payment instructions across borders. It worked brilliantly for decades, creating efficiency, transparency, and trust in cross-border transactions. But it also created a single point of control. Because nearly every significant international transaction touches a US correspondent bank at some point, the United States government can monitor, track, and if necessary, block transactions that involve sanctioned entities. This is how sanctions work in practice, not through military blockades or border enforcement, but through financial exclusion. When the US sanctioned Iranian banks in 2012, it didn't send warships to Tehran. It disconnected Iranian financial institutions from SWIFT and cut off their access to correspondent banking in dollars. Overnight, Iran's ability to conduct international trade collapsed, not because goods couldn't physically move, but because payment settlement became nearly impossible. The same mechanism was deployed against Russia after the 2022 invasion of Ukraine, against North Korea, against Venezuela, against any nation or entity that the United States determined threatened its interests or violated international norms. Sanctions became the primary tool of statecraft, more flexible than war, more immediate than diplomacy, and devastatingly effective because the global economy runs on dollars and dollars route through systems the US controls. But every system built on centralized control creates an incentive for alternatives, and that's exactly what mBridge represents. Project mBridge began in 2021 as a collaboration between the Bank for International Settlements Innovation Hub, the People's Bank of China, the Hong Kong Monetary Authority, the Central Bank of Thailand, and the Central Bank of the United Arab Emirates. The stated goal was technical: develop a platform for instant cross-border payments using central bank digital currencies, or CBDCs. CBDCs are digital versions of sovereign currency issued directly by central banks, distinct from cryptocurrencies like Bitcoin because they're backed by governments and represent legal tender. The innovation of mBridge is the architecture it uses to connect these digital currencies. Instead of routing through correspondent banks and SWIFT messaging, mBridge uses distributed ledger technology, essentially a shared database that all participating central banks can access simultaneously. When the Central Bank of Thailand wants to settle a payment with the People's Bank of China, the transaction occurs directly on the mBridge platform. The Thai digital bot is converted to Chinese digital yuan instantly. The ledger updates in real time, and settlement completes in seconds rather than days. No correspondent bank in New York touches the transaction. No SWIFT message is sent. No dollar is used as an intermediary currency. The transaction is invisible to Western financial surveillance because it never enters Western financial infrastructure. This is not theoretical. Pilot transactions have been running since 2022. In September 2023, mBridge completed a test involving 20 commercial banks across 4 jurisdictions, settling real value transactions totaling over $22 million equivalent. The system worked. Settlement times averaged under 30 seconds. Costs were 50% lower than traditional correspondent banking. And most critically, the entire process was opaque to US regulators. The geopolitical significance became clear in June 2024 when the Bank for International Settlements, the so-called central bank of central banks headquartered in Switzerland, announced it was withdrawing from direct involvement in mBridge. The official statement cited strategic priorities and resource allocation, but intelligence analysts noted the timing. The announcement came weeks after intense lobbying from the U.S. Treasury Department, which had become alarmed at mBridge's progress and its potential to undermine sanctions enforcement. But here's what matters. The BIS withdrawal didn't kill the project. The code had already been written, the platform had already been tested, and the participating central banks had already committed to moving forward independently. By October 2024, Saudi Arabia joined as an observer, signaling that even U.S. allies were exploring alternatives to dollar-dependent settlement. In January 2026, with India taking the BRICS chairship, mBridge transitioned from pilot to operational infrastructure. The announcement was deliberately low-key, no press conference, no dramatic unveiling, just a technical notice that participating central banks could now use mBridge for actual trade settlement. Within weeks, the first commercial oil transaction settled entirely outside the dollar system. The United Arab Emirates sold crude oil to China, payment was made in digital yuan, settlement occurred on mBridge, and the entire transaction bypassed every Western financial institution. The cargo loaded at Jebel Ali sailed to Shanghai, and the payment cleared before the tanker reached port. No correspondent bank was notified, no SWIFT message was logged, and no U.S. regulator had visibility into the transaction. This is the silent heist, not stealing money, but stealing the architecture of control. To understand the historical parallel, you need to go back to the 1960s and the birth of the euro-dollar market. After World War II, the Bretton Woods system made the U.S. dollar the world's reserve currency, backed by gold and managed through strict capital controls. But by the 1960s, dollars were accumulating outside the United States, held by foreign banks and corporations that wanted to use them for trade, but didn't want to route every transaction through New York. These offshore dollars, called euro dollars, because they were primarily held in European banks, created a parallel financial system that operated beyond U.S. regulatory control. The eurodollar market exploded in size, reaching hundreds of billions of dollars by the 1970s, and fundamentally changed how international finance worked. It gave global banks flexibility to lend and borrow dollars without U.S. oversight. It created liquidity pools that fueled international trade, and critically, it demonstrated that money could escape the control of the nation that issued it. The U.S. government initially tried to suppress the euro-dollar market through regulation, but the economic logic was too powerful. Businesses wanted the efficiency, banks wanted the profit, and foreign governments wanted the autonomy. Eventually, the U.S. adapted, accepting that some dollar transactions would occur beyond its direct control, but maintaining influence through the Federal Reserve's role as lender of last resort. mBridge represents a similar moment, but with a crucial difference. Eurodollars were still dollars, still ultimately dependent on U.S. monetary policy and U.S. financial institutions for settlement in extremis. mBridge transactions use sovereign digital currencies that have no inherent connection to the dollar system at all. This is not money escaping regulation. This is money escaping the currency entirely. The immediate strategic implication is sanctions evasion, but the deeper implication is the fragmentation of global liquidity. For decades, the dollar served as the universal medium of exchange for international trade, even between countries that had no economic relationship with the United States. If Brazil wanted to buy machinery from Germany, the transaction would often be denominated in dollars because both parties trusted dollar liquidity and dollar settlement infrastructure. This created enormous demand for dollars globally, which allowed the United States to run persistent trade deficits without currency collapse because foreign entities needed dollars to participate in global commerce. But mBridge breaks this dependency for participating countries. If China and the UAE can settle oil trades in digital currencies, they no longer need to hold as many dollar reserves. If Thailand and India can pay for goods in their own CBDCs, they reduce their exposure to dollar volatility and Federal Reserve policy decisions. The immediate effect is not dollar collapse. The dollar remains dominant in global reserves and international debt, but the marginal demand for dollars begins to erode. This erosion matters most at the edges, in transactions involving countries under U.S. sanctions or countries that want to reduce their vulnerability to U.S. financial pressure. Russia, after being cut off from SWIFT in 2022, has been desperate for alternatives and has reportedly integrated with mBridge through Chinese intermediaries. Iran, facing decades of sanctions, has explored using the platform for oil sales to China and India, receiving payment in digital yuan that can be converted to goods without touching Western banks. Venezuela, North Korea, and other sanctioned states are watching closely because mBridge offers a technical solution to their primary economic problem: how to conduct trade when you're excluded from dollar-based settlement. The United States cannot simply shut down mBridge the way it shut down smaller payment platforms in the past. The participating central banks are sovereign institutions The technology is distributed across multiple jurisdictions, and the transactions occur on infrastructure that Western regulators cannot access. You cannot sanction a ledger. The economic consequences extend beyond sanctions to the structure of global trade itself. One reason the US dollar became dominant after World War II was the concept of network effects in currency. The more people use a currency, the more valuable it becomes because liquidity deepens and transaction costs fall. mBridge creates an alternative network, smaller initially but growing, where liquidity exists in multiple currencies simultaneously rather than concentrating in dollars. This is visible in commodity markets where traditional pricing mechanisms are shifting. For decades, oil has been priced in dollars globally, the so-called petrodollar system, where producers quote prices in dollars and buyers pay in dollars regardless of where the oil is pumped or consumed. But in March 2026, Saudi Arabia announced it would begin accepting payment for oil sales to China in digital yuan, settled through mBridge. The announcement was framed as payment flexibility rather than de-dollarization. But the effect is the same. Chinese refiners can now purchase Saudi crude without converting yuan to dollars, eliminating currency risk and reducing transaction costs. This doesn't end dollar pricing for oil globally. The United States, Europe, and most Asian buyers still transact in dollars. But it fragments the pricing mechanism. Fragmentation creates arbitrage opportunities where the same barrel of oil might trade at slightly different prices depending on the currency used for settlement. Over time, this could lead to multiple pricing benchmarks, a dollar price, a yuan price, a rupee price, each reflecting regional liquidity and trade relationships rather than a single global standard. The implications for U.S. monetary policy are profound. The Federal Reserve has operated for decades with the assumption that dollar interest rate changes transmit globally through the reserve currency system. If the Fed raises rates, dollar liquidity tightens everywhere, affecting trade finance from São Paulo to Singapore. But if a significant portion of trade shifts to mBridge settlement in local currencies, the transmission mechanism weakens. Countries can insulate themselves from Fed policy decisions by conducting more trade outside the dollar system. This reduces the Fed's influence over global financial conditions, but also reduces the exorbitant privilege the U.S. has enjoyed, the ability to borrow cheaply because the world needs dollars. The response from Washington has been fragmented and reactive rather than strategic. The Treasury Department has explored creating a digital dollar CBDC that could compete with mBridge, but implementation faces political opposition from privacy advocates and cryptocurrency proponents who see CBDCs as government overreach. The State Department has pressured allies to avoid mBridge integration, with mixed results. Countries like Japan and South Korea have stayed away, but others like UAE and Saudi Arabia have moved forward. The intelligence community has attempted to penetrate mBridge's operational security, seeking to monitor transactions, even if they can't block them. But distributed ledger architecture makes this extraordinarily difficult. Some strategists have proposed a more aggressive approach, threatening secondary sanctions on any financial institution that facilitates mBridge transactions involving sanctioned entities. But this creates enforcement nightmares because mBridge transactions are peer-to-peer between central banks. There's no commercial bank intermediary to sanction. You would have to sanction the central banks themselves, which means sanctioning entire countries, an escalation that could fracture the global financial system entirely. The reality is that mBridge exploits a fundamental weakness in the dollar-based sanctions regime. It was built for a world where all roads led through New York, but technology has built new roads that bypass New York entirely. The long-term strategic question is whether mBridge represents the beginning of a multipolar currency system, or whether the dollar's network effects will ultimately contain the challenge. History offers examples of both outcomes. In the 16th century, multiple reserve currencies coexisted: Spanish silver, Venetian ducats, Dutch guilders, each dominant in different regions and trade networks. But in the 19th century, the British pound achieved singular dominance through the pound sterling's connection to gold, the Royal Navy's protection of trade routes, and London's role as the world's financial hub. That dominance lasted until World War II exhausted Britain's financial capacity, and the US dollar replaced sterling as the global reserve. The transition took decades and was resisted by British policymakers who understood that reserve currency status conferred enormous economic and political advantages. The United States is now in a similar position, defending dollar dominance not through gold backing or military supremacy alone, but through the architecture of international finance. mBridge attacks that architecture at its most vulnerable point, the assumption that there is no alternative. For 50 years, countries that wanted to participate in global trade had no choice but to use dollar-based systems, because no credible alternative existed. Now an alternative exists, limited in scope currently, but expanding in capability and membership. The question is whether enough countries adopt it to create a self-sustaining network effect, or whether the dollar's incumbency advantage, the depth of U.S. capital markets, the security of U.S. institutions, and the inertia of existing contracts proves too strong to overcome. What makes this moment particularly significant is the convergence of economic incentives and geopolitical tensions. Countries joining mBridge aren't just seeking technical efficiency, they're seeking strategic autonomy from a system they perceive as weaponized. When the United States froze Russian central bank reserves in 2022, over $300 billion in assets, it demonstrated that holding dollar reserves provides no protection if political relationships deteriorate. That action sent a signal to every central bank governor in the world. Dollar assets can be seized, frozen, or blocked if Washington decides you're an adversary. For countries like China, with over $800 billion in U.S. Treasury holdings, this creates an existential vulnerability. Those reserves are simultaneously a source of economic stability and a potential hostage to U.S. foreign policy. mBridge offers a way to reduce that vulnerability by conducting trade in ways that don't accumulate dollar liabilities. The irony is that U.S. sanctions policy, which was designed to maximize American leverage, may have accelerated the development of systems designed to escape that leverage. The technical evolution of mBridge continues, with new features being tested that increase its utility and attractiveness. In February 2026, developers announced atomic settlement capability, meaning that multi-currency transactions can settle simultaneously across all parties without any intermediary holding funds temporarily. This eliminates a settlement risk, the possibility that one party pays but the other doesn't deliver, which has been a persistent problem in cross-border trade. The same month, mBridge integrated with smart contract functionality, allowing automated execution of trade finance arrangements without manual bank intervention. A letter of credit, which traditionally requires multiple banks to verify documents and release funds, can now execute automatically when shipping data confirms cargo delivery. These innovations make mBridge not just an alternative to SWIFT, but potentially superior for certain types of transactions. The combination of speed, lower cost, reduced counterparty risk, and automated execution creates genuine economic value that exists independent of geopolitical considerations. Even countries with strong ties to the United States might choose to use mBridge for specific trade flows simply because it's more efficient. This is how alternative systems gain adoption, not through ideological commitment, but through practical advantage. The fragmentation of global payments creates winners and losers beyond just the US and China. Countries positioned as bridge nodes in the new system, those connected to both dollar infrastructure and mBridge, gain enormous strategic leverage. The UAE, for example, has integrated with mBridge while maintaining deep financial ties to New York and London. This allows Emirati banks to offer clients access to both systems, capturing business from entities that need flexibility across geopolitical boundaries. Singapore is pursuing a similar strategy, developing its own CBDC while maintaining connections to Western banking. These countries become the Switzerland of digital currency, neutral platforms where different monetary systems can interact without direct confrontation. By contrast, countries that remained fully dependent on dollar infrastructure without developing alternatives may find themselves with reduced negotiating power as the payment landscape fragments. The ability to access multiple settlement systems becomes a form of economic sovereignty. For global corporations, mBridge creates both opportunities and compliance nightmares. A multinational company operating across Asia can reduce forex risk and transaction costs by using mBridge for regional trade. But doing so may trigger scrutiny from U.S. regulators if any part of the transaction involves sanctioned entities. The result is a bifurcation of corporate treasury operations. Some flows moving through traditional dollar channels for transparency and regulatory compliance, others moving through mBridge for efficiency and cost savings. Managing this dual system approach requires sophisticated financial infrastructure and legal expertise, creating barriers to entry that favor large corporations over smaller businesses. Insurance companies and shipping firms face similar complications. Pricing risk and structuring contracts becomes exponentially more complex when multiple payment systems with different legal frameworks are in play. The strategic question facing U.S. policymakers is whether to resist mBridge's expansion or to adapt by creating interoperability frameworks that preserve some degree of oversight. Resistance appears increasingly futile. The technology exists, the participating countries are committed, and attempts to block it would likely accelerate fragmentation rather than prevent it. Adaptation might involve negotiating data sharing agreements with mBridge participants, allowing U.S. regulators to monitor transactions involving American entities, even if those transactions settle outside dollar infrastructure. It might involve creating on-ramps, where mBridge liquidity can convert to dollars under supervised conditions, maintaining some degree of connection rather than allowing complete separation. But any adaptation framework requires cooperation from countries that view financial autonomy as the entire point of mBridge, making consensus difficult. The historical pattern suggests that reserve currency transitions are generational, not sudden. The pound sterling didn't collapse overnight when the dollar rose to prominence. It declined gradually across decades as U.S. economic power grew and British influence waned. The dollar may follow a similar trajectory, remaining dominant for certain functions, deep capital markets, debt issuance, commodity pricing, while losing ground in others, trade settlement, currency reserves, payment infrastructure. mBridge accelerates this process by providing a functional alternative where none existed before. But acceleration doesn't mean inevitability. Network effects can be surprisingly resilient, and the dollar benefits from decades of accumulated trust, legal frameworks, and institutional depth. The outcome will depend on factors beyond just technology: U.S. economic performance, geopolitical stability, the credibility of alternative systems, and whether mBridge participants can maintain the system during crisis conditions. Because ultimately, the test of any financial infrastructure is not how it performs during normal times, but whether it survives under stress. The dollar system survived the 2008 financial crisis, proving its resilience when liquidity dried up globally and everyone fled to U.S. Treasury securities. mBridge has never faced a comparable test, and won't until a major participant faces a financial crisis and needs emergency liquidity support. Whether the system can provide that support without a lender of a last resort backstop remains an open question. What is clear is that the architecture of international finance is undergoing its most significant transformation since the 1970s. The mechanisms that gave the United States extraordinary economic leverage, the ability to track global money flows, the power to exclude adversaries from trade, the capacity to enforce policy through financial pressure, are being systematically weakened by technology that was specifically designed to escape that control. This is not the end of the dollar, but it is the end of dollar monopoly. It's the beginning of a period where multiple payment systems, multiple currencies, and multiple sources of financial power coexist, creating a more complex and potentially more fragile global economy. The silent heist is complete, not stealing wealth, but stealing the singular point of control that made modern sanctions possible. And unlike a bank robbery, there's no way to recover what was taken, because what was taken wasn't money. It was inevitability, the assumption that all roads must lead through New York. Now there are other roads, and traffic is already flowing.